Hello everybody and welcome to Green Star Trading with me, Tom. All views, opinions and ideas expressed in this video are my own and do not constitute financial or trading advice in any way. Right, time to do a video on gold and silver. It's been a fair old while since I've updated these for YouTube. Now I know some of you have been a little upset about that. I've explained in the past why it's the case, that I've covered what I covered when I can, because that's all I've been able to do. But I'm now starting to find a slightly better balance, work-life balance, between being stay-at-home dad, full-time parent, looking after my infant son, and also finding a few more hours in the week to devote to work. Now obviously I want to add value to my Patreon subscribers, whose support I've greatly appreciated during this period, but I don't want the YouTube channel to fall apart. I don't want it to die, I don't want it to be forgotten about. You know, I've put a lot of work into it over the years and I've grown it sufficiently, and it's time to try and get it moving again. So I got that update out on the S&P 500 for Sunday. This will be out it's Monday today when I'm recording it. It'll be out on Tuesday on YouTube. Patrons will get it later today on Monday once I upload a link to the Discord. So the point being is I'm going through and updating all my charts, and I'm finding a lot of work that I need to do, and I'm trying to get the hours in the day to get it done. But there are going to be things here and there that we need to do on the fly as we update and as I do these videos. If we run into such things, please bear with me. I will get it done as soon as I can, and I will make sure it's more updated or up to speed for next time we do a video. So without further ado, let's get underway. Okay, like I said, gold and silver today. The CFDs and gold and the SLV will be our proxy for the silver market. Now if my voice gets a little weird during this episode, or if I cough a bit, it was Guy Fawkes night last night, and I always celebrate Guy Fawkes, true Englishman, and I believe it should be an English bank holiday. It is not, unfortunately. I believe it should be, but it means I had a bonfire on the go last night in the garden, set off a bunch of fireworks. I've probably inhaled a fair bit of smoke. My chest is feeling a bit this morning, so we're just going to do the best and muscle on through as best as we can. So starting here with gold, I'm bullish. No surprise there. Anyone who's been on the YouTube channel before, looked at any of my previous videos on gold and silver, will know that I've been bullish, well, for multiple years now, and still am. And I think we're going higher, and I think we're off to new highs in the not too distant future. That's what I think is happening. There is of course a bearish count we'll look at as well. I always believe you should have an alternate. But before I touch on the specific primary and alternate bearish counts, I just want to pull back, turn off the counts for a minute, do some classical technical analysis and point out a few things of note. Right, so we are just off the highs. In the great scheme of things over the history of this the price of this asset, we're just off the highs. Right, and probably within 5% or 6% or something. Yeah, within 5%, 4.74. Okay, so we're just off the highs, and this structure is not very typical of how we come off of the highs in gold if we're bearish. Right, so let me show you what I mean. Let's come back to 2011. Okay, and let's see how the closest we got back to the high were these three tops here, which were not level with the high, and sat a good 774 basis points off the high, 7.7%. Okay, as you can see here, these three highs are in a row. If you were bearish, you could call it a triple top. I have seen people incorrectly call it a head and shoulders. It is not a head and shoulders. This high is higher than the head, and this high is higher than the head, and you'd look a bit bloody weird if you were walking around with your shoulders above your head. It's called a head and shoulders for a reason, because your shoulders are lower than the top of your head. Well, unless you're Uncle Fester from Adam's Family, but even he, I think, could argue that his head was above his shoulders. But point being, it's not a head and shoulder structure. It might be a triple top, which is which could be a bearish structure. It could be, well, yeah, but it's basically how you'd have to look at it if you wanted to be bearish. But coming back to, like I said, 2011, we get a correction from top to bottom of 1,568 days ish, give or take a few, and we get a period of time between the highs at the top of around 402 days, and they don't come back to the prior highs. If we go all the way back to sorry, no, it's not 2000. It's going back much further. Let's go all the way back to the next major high. Here we are, which is 1980. Right, we come down, we come back up. This high finishes within 21.4%, or 20%-ish of the high, right? And from that one high to the next high, we get a period of time of around about 255 days. Now, this correction is absolutely gigantic. Let's just zoom out so we can get an idea from top to bottom. Top to bottom. Okay, this is a 7,217 day correction. It's a big sucker, right? Minimal amount of time spent hanging around the highs. Significant drop on the next lower high. Right, prior to that, we're picking out what I believe are subwaves of that first big wave up. This is the first big correction. This is a massive wave 2 degree. Wave 2, take your pick. Super cycle, grand super cycle, la-di-da, whatever. It's 7,000 days long. It's big. Right, this is the next larger wave degree. This is still a significant amount of time, as we discovered. Okay, you know, this is 1,600 days. Right, and then we get this behaviour that we've got here. Right. Now, given that the period here was what was it? Between the highs before we drop down. Maybe it might help if I get the measuring tool out. Now, this was 399 days. Right, time before that, between the highs, was 200 and something. Now, what makes this period and behaviour different across these three tops here to present day, because we're still within 5% of the high? This is 1,190 days we've spent just off the highs, essentially. Now, you might say, well, that low isn't just off the highs, but in the great scheme of things, it is, really, and we're even closer now within 5% of it, right? So this is not typically how the gold market peaks. Not how it typically tops out and then reverses, is it? It looks a little different. Well, I'd argue significantly differently. So overall, this helps support my bullish case in my head, at least. The next thing I find quite interesting is if we look at these major weekly moving averages, we know historically that when we get a major correction, a big correction, we move through the 60 moves through the 250 and closes below the 250 on the weekly time frame, where we get a significant correction. We can see here this is a very significant correction, as is this one. Now this one moves back to the 250 and just pierces it. So this leads me to believe that we are either still in a 5-wave move higher that's yet to conclude, and this is one of the waves within it, the wave 4, as this wave 2 which pierced it was the first deeper wave, and then we get the wave 4 here, and then we push up into the wave 5, or there is another alternative which is even more bullish. So now let's introduce simplistic views of accounts. So first things first, this is one way of looking at it, that we have a 1, 2, 3, 4 primary degree, and then we've got 5 waves up to come in an extended 5th. Quite common in commodity markets. Now if you want to be bearish, you can just put the 5th here, say that it finished slightly truncated to the prior high. Okay, and then you can get 5 waves in here, so we can do that. The bearish count from there would be that we've had 1 down, 2 back. This needs to be down to minute degree, sorry. 1, what we'll do is get rid of that minute degree there, so we can see more clearly. Bear with me. Alright. 1 down, expanding flat back into 2, 3, 4, 5 into A, B, C, down to anywhere all the way down to not beyond $1,000, or 1,050 roundabout was the prior low. I would expect it to settle inside of here somewhere, and this would be a larger wave degree correction. I would have that actually as a cycle wave correction. Okay, because we've just got to switch off that one there. 1, 2, 3, 4, 5. I've got this as primary, but we could have this as cycle. It depends how you want to look at it. It doesn't really matter. 3, 4, 5 would have it as cycle here. That would be 1. Then we'd come down in that big 3-wave move into a cycle wave correction, which should be significant in scale. Okay, so that would be the bearish way of looking at it. Another way, and we would express it like that, another way of looking at it is that we're entering an extended fifth. Okay, like I said, quite common in commodity markets. We're going to go 1, 2, 3, 4, 5 up like that into 5. 1, 2, 3, 4, 5, and we'll end up with some kind of structure which looks very much like this. Okay. Okay. Another way of looking at it, which I'm starting to consider more and more, I haven't made my mind up as to which one I like. I am more focused on the immediate count, but I'm just considering these ideas. And that is this, that we've actually had 5 waves up. Okay. 1, 2, 1, 2, 3, 4, 3, 4, 5. Into primary wave 1, A, B, C. Flat pattern into 2, 1, 2, intermediate degree, now entering a primary 3 of cycle 3, of an even larger 3. This is extremely bullish, of course. I'm not decided as of yet onto the long-term view, but they're basically the 2 options I see. We're either into the 5th wave now, of a larger cycle degree, or we're just entering the wave 3 of a larger cycle degree, primary degree into a larger cycle degree. Okay, so they're the 2 ways I look at it. And then we've got the bearish idea, which is we've already topped out, and now we've got 1, 2, we've got a total collapse on our hands now, and things are going to get very, very bearish. Alright, so there's the 3 counts in the most simplistic sense that we can see. Now, if we just come out and have a look at the classical analysis for a moment, the technicals. Okay, so starting here on the weekly time frame, as I pointed out, we've come back to the 250 exponential moving average on the weekly time frame. Okay, signifying the likely conclusion of a major correction. Okay, and in that time we went from overbought conditions on the weekly time frame to oversold conditions on the weekly time frame. Since those lows came in, we have once again gone back up to overbought conditions and back to just touching oversold conditions again. So there's a good argument to suggest that you've got the completion of a larger wave degree correction followed by the completion of a smaller wave degree correction. Now we've already discussed that that could be 1 into 2, 1 into 2, but it could be 3 into 4, 1 into 2, or it could be 3 into 4 into 5 to get this high. Now we can't say there's divergent highs up here per se. I mean, because we operate on the closing price to get our RSI readings, we actually have lower closes here, higher intraday pricing with the wick on the weekly on the CFDs, but lower closes than we had all the way back here. So the divergence, any divergence between this high back here and the high back here is not bearish divergence, because these are lower closes. Now if these were higher closes and we had lower closes on the RSI, this would be bearish divergence. So we can't read into it and say, well, it's bearish because we're RSI is diverging from price, MACD is diverging from price. It's not. They're calculated on the closing price. So to me it looks like the completion of a correction and another move up that has now begun. But that's very much that's up for debate, like everything else. So if we come down to the daily time frame, we can see that the recent sell-off took us to deeply oversold conditions on the daily time frame. If I just put a horizontal across there for a moment, there is it. There it is. So we reached oversold conditions on the daily time frame, right? That we haven't seen since 2015. So this is some seriously aggressive selling off. Okay, and this seriously aggressive selling off was followed by some seriously aggressive bounce straight back into overbought conditions. Okay, on the shorter time frame now, we've brought the MACD back above the zero bound, the average through the signal line, and now we're starting to roll over. That bearish, the bullish momentum is starting to die off. We've got a little red bar here on the histogram, a little cross of the average through the signal. but still well above the zero bound. So some kind of pullback as we lose momentum is likely in the shorter term. But I would argue, as part of a longer term consolidatory pattern of consolidation, this move off of the oversold conditions on the daily time frame is the most significant kind of bullish momentum we've seen for a fair old while. You know, going back to March 2023, since we got to these kind of aggressive momentum readings. Okay, so that was all correction, just as this was all correction, and now we've got a bullish phase to come, and this is just the first move up off of that low. That's how I'm choosing to interpret it, or how my preference is. You can interpret it differently, but that's my preference for interpreting it currently. Okay, now if we look at what we've retraced since the high, the most recent high, right, we've come back to and through the golden zone somewhat. If we just come off of log for a minute, so we've gone more than 61.8%. If you pierce the 61.8% retracement, more often than not you'll continue higher or continue lower depending on whether you're retracing up or down. Right, that should operate as pretty stiff, pretty certain resistance. And we seem to have come up in a single impulsive move. I argue that that's very impulsive behaviour, not a clear zigzag corrective behaviour, but an impulse, which suggests it's not done. Okay, so if you were thinking that this is 1 A, B, C, that's the only real explanation for a bearish count in my book. 3 to here, 3 to here, 5 to here, an expanded flat pattern. Okay, and in that regard, finishing beyond where the A began is permissible and expected, so that would explain the breach. But if we're looking at this as a free wave correction, which I would argue has a lot more merit, then this looks bloody impulsive and very bullish. So one would expect a move up, a move back, and then a move to new highs, because we move in at least 3 waves: 5, 3, 5, 1, 2, 3, then 4 and 5 to get 5, or A, B, C. Either way, I would expect a higher move and move back to new all-time highs. The alternative is that we had 5 down, A, B, C bearish, right? But it's not my preference. So anyway, that's enough with the technical analysis, classical analysis. There's nothing else to really discuss. So let's come in and have a look at the actual counts. So, excuse me, a bit of a cough. Like I said, you know, it was Guy Fawkes last night, and I inhaled a fair bit of smoke. Had a bonfire going in the garden, and a lovely evening, but still definitely inhaled some smoke last night. Either way, getting on with it. 1, 2, 3, 4, 5. Extended wave 1. 3 is still not the shortest. 5 is shorter than 3. 4 does not overlap wave 1 price territory. Now, you could draw this like a diagonal, but like I said, the 4 doesn't overlap the 1. So I'm just looking at it as an extended 1. That's one way of getting up here. An alternative would be that we actually bottomed earlier, and this is 1, and this is 2, this is 3, this is 4, and this is 5. This generally has a nicer look, but boy oh boy, is that a deeper correction, a deep correction for a wave 2. Now it can come anywhere back to 99.9999%, just can't retrace all of wave 1. It can retrace all the way up to just the last available decimal point. Right, but we have to be practical, okay, and that's pretty much a full retracement. So, and I'm not particularly a fan of it because of the prior corrective move where I've got WXY fits better, in my opinion, as a flat A, B, C with an ending diagonal in the 5th of the C. Right, so that's how I've chosen to look at it. But my point is, it doesn't matter. Right, it doesn't matter how you get up here. We can get up here for 1. Right, whether we get up here as 1, 2, 3, 4, 5, or whether we get up here as 1, 2, 3, 4, 5. It doesn't matter. We can get up here in 5 into a 1. From there, we've got a corrective channel on our hands, right? And it's pretty neat. Okay, we come down in an A. We then get a running triangle, A, B, C, D, E for a B, 5 down in the C, beautiful corrective channel ABC. We then breached that channel, excuse me, to the upside, and this is our new wave 1. So what we're going to do is we're just going to label that now and add that into the count. We're going to go 1, I think this is likely 1, 1, 2, 3, 4, 5, A, B, C, down. Maybe testing the bottom of the pitchfork, that would be a very logical thing to do. Looking for the median line, maybe higher. Obviously as we come up into the intermediate degree, we'll correct 1, 2, then 3 into 4, then 5, so on and so forth. So let's just put this down to minor degree. Let's spread this out because we don't know how long this is going to take or how high it's going to take us. Or even if this is the correct degree yet, this will all become more clear over time. Let's come down to the 4 hour now. We're going to move out all this along. Right, so could be 3, 4 there, done. Could be a little bit further. I don't think it matters all that much. I think we've come up pretty fast, pretty violently. Some kind of correction is likely. So we'll add that in. So as you can see, it's 1 into 2 into here, 1 into 2 to come. Now it doesn't have to come that deeply, but what I do notice about the wave 2 correction here is it finished right within the target zone for a wave 2 correction. Okay, came straight into the 50 to 61.8%, which is our target box for a wave 2 retracement. It also obviously came back into prior support, prior resistance being tested as support, being tested as support again. Excuse me. So back test of a downward corrective channel, that's quite common as well. You've got a nice little confluence here between the back test of the channel and the back test of the pitchfork here, so maybe we want to do something like this and come down to here before swinging higher, aiming for this median line. Okay, that would be very typical behavior. If we just take a quick look at where that would bring us into Fibonacci territory, it just so happens that the golden zone perfectly sits on the back edge of the corrective channel and happens to sit bang on the edge of that pitchfork as well. So I'm not saying it has to happen, but if the algorithms want it to happen like that, there's a bloody good reason for it to do it. So that's how I see the bullish count at the moment. That's my preference. I'm still working on updating some of the shorter time frame stuff, picking apart some of the smaller sub-weight degrees. Like this was extremely messy, but you've got to work with what you've got basically. So we're bullish. We think we've completed the minor wave 1. I think we're going to be coming back in the minor wave 2, and then we'll be pressing on to new highs. Right, likely pushing that wave 3 of the intermediate degree beyond these excuse me, these previous 3 peaks, breaking out of this 1,000+ day consolidatory phase. Okay, so there you go. That's all brown pretty bullish, isn't it? Now let's add those few things to the primary. So switch that off. The bearish count then on the smaller time frame. I haven't got as much detail here, but the idea is pretty simple. The reason this has come up so sharp, so fast, is because it's the C leg of an expanded flat. So this was the all-time high back here. We've come down in 1. We've gone A, B, and C. Now if we just do some measurements for a moment, we can see excuse me, that the B wave extends beyond the 161.8 of the length of the A wave. Now that tends to be the cutoff for the expansive B wave of a flat pattern. It can go beyond it, but anything it does is considered very extreme. 123.6, 130.18 much more common. So then if we take the length of the A projected from the B, we can see that we've gone well beyond the 1618 to the other side as well, also quite extreme. So it structurally looks okay as a flat pattern, but it doesn't much behave like one. Now, another thing that I don't particularly like the look of is the fact that this very much does feel like there's 5 waves up here. Okay. But that's problematic in itself. You know, because we still need to subdivide that wave as a zigzag. We can go A, B, 5 and a C. So it's not too big a problem. This very much had me fooled, if I remember, going back to June this year, where I thought we saw 5 up, looking for 3 back, and then we went lower. So things sometimes just look a bit peculiar. But then I didn't know that it was going to morph into this triangle structure, did I? Can't see into the future. Now that definitely appears to simply be an A, a B wave triangle, and a C. So let's save that there. I think that's enough for gold. Right, if there's anything I haven't touched on, feel free to comment in the comment section and let me know what you're thinking. So now we're going to come over to silver, the SLV. Now, I can't say anything other than it's messy and it's difficult to get a count on this. Okay, first thing I want to say is when I look at the move from the high on the weekly time frame going back to 2011 to the low of 2020, I feel that a decline of 82% over a correction of 3,270 something days is sufficient to say that was the fucking low. Okay? Now you can disagree, that's fine, but that's enough. Now, considering that the gold price is just off the highs and has been lingering around there for a bloody long time, it would strike me as particularly odd that silver doesn't rally to chase it, or rally to move up to at least get somewhere towards its previous all-time highs. And yet it's sat down here lingering around on the launch pad, and I believe it is on the launch pad waiting to move up. And I believe that first move up was that first wave 1, and this was the first wave 2, and this is the next wave 1, and this is the next wave 2, and we're about to do this. We're about to break higher. Now I could be wrong, and the count is tricky, there's no doubt about it. Okay, I can't argue that fact. All I can do is give you my best explanation for what I think is happening. So let's do that. You'll have to forgive the cough. Like I said, my throat is very scratchy at the moment. Alright, so I have 5 waves up into a primary wave 1. You can put the 3, 4 here. You can try and put it here and get a disproportionately large 4 into a peak here for the 5. You can do it the way I've done it. The 3 is still not the shortest wave, and you get a massive extended 5th. Whatever. We can get up here in 1. It came up like a rocket off the back of COVID. Okay, so it doesn't look great. We get W, X and Y subdividing into a series of zigzags. This can also be interpreted differently as well. Let me show you what I mean. I've used the alternate idea in the bearish count, and this is where we get a flat pattern. 3 into A, 3 into B as a double zigzag, and then we get zigzag, 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 ending diagonal in the C for a W. So we go W, X, Y, that's how we go lower. Or you could go A, B, C, 1 into 2, done. Alright, either's viable. We got into a 1, we can get into a 2. We've got a couple of ways of doing it. La-di-da. Where it gets tricky is coming off of this bloody low. Because we've got either 1, 2, 3, 4, 5. Some charts, I've had it pointed out to me, in silver price, we get an overlap. And therefore I've just put these 2 converging lines around it to suggest that it could be a diagonal. On here on the SLV, it's arguable that we do not get an overlap. And therefore we can look at it as an extended 1. We had an extended 1 in gold. Right? We have an extended 1, a deep 2, a smaller 3, an even smaller 4, and a very brief 5. Creating something that looks very much like a diagonal, but can, if there is no overlap, be legally counted as an impulse, and if you think there is an overlap can be legally counted as a diagonal. So everyone's happy, right? Or no one is. It doesn't matter. It's legal either way. From there, we get, let's tidy this up a wee bit. Turn the fib off. So we've got a corrective channel, but we're still in. This high, I've ignored this Wall Street's bet candle, and we've just gone this high to this high to this high to this high. We're still in a downward channel. In other words, I'm giving the bears the benefit of the doubt here. That is actually the corrective channel. We've then had a corrective channel within that corrective channel for what I believe was the wave 2. Now the way I've counted this is, once again, different chart but similar correction. Zigzag down into W, A, B, C, D, E, zigzag down into Y, into 2. We've got a X-wave triangle here, and it's not great proportions, okay, but it's just the best I can do. From there, we've had a move up into a wave 1, and we've moved down, back up, and I think we might have a flat pattern going on here, and we'll be coming back into a wave 2. We're now essentially at the same point of the gold count, okay, but either aligned with it perfectly, 1 2 1 2, which is my alternate idea, except the 1 2 in gold took us back to previous highs, or gold is an entire primary degree leg ahead of silver in the having completed the 3rd and 4th wave now in the 5th. We've done the 1 and the 2 now in the 3rd. There's an argument for both. You could argue that silver lags gold because everyone buys gold first. When gold becomes too expensive, they look around for what else they can buy. They realise silver is still cheap, so they buy that. So it has its leg, 3rd leg behind gold. It lags gold, right? So that's a logical argument. The alternative is, like I said, they're both doing 1 2 1 2, but gold's 1 2 went all the way back to prior highs, whereas silver didn't. But silver suffered an 82% decline. Let's just try and remember that. Okay. That's the best I got. Right, I haven't fleshed all this out. Like I said, charts need some work. An alternative way of looking at it is this. We get an impulse into 1, and we get 1 into 2 intermediate degree, 1 into 2 and minor degree. I don't like it because the minor degree is just so much bigger than the intermediate degree, which it shouldn't be. Now, it can be a little bit bigger if we're in an exponential count, where we're going into the 3 over 3 over 3 and we're getting stretched out like an accordion and everything's getting bigger rather than smaller. We can give it a few days here and there, we can give it some latitude. But when we get a disparity of this scale, it doesn't make any sense because we're still so close to it. It just doesn't look right and it doesn't make any sense. I just don't like that count at all. So I've got to look at this as 1 2 3 4 5, either a impulse without an overlap or a diagonal with. I did consider an expanding leading diagonal before everyone jumps down my throat. Zigzag into 1 2 3 4 5. The 5th is shorter than the 3rd. In an expanding diagonal, that's just not allowed. 5th has to be longer than the 3rd, 3rd has to be longer than the 1st wave. So this is not an expanding diag. Okay, and if I tried to get it to line up 1 2 off the bottom here, right, like that, we've got the same problem. Either the 3 is going to be huge up to here and then come down to the 4th, so we won't know. If we come back down to the 1 and aim for that 3, we overthrow in what would be the ABC of that zigzag, or we're miles away from the top of it. So it just doesn't look right to me. So there's the bullish count, 1 2 1 2. Long term, it just seems to make sense having come off such a massive decline. And we've spent so much time going sideways. If we wanted to collapse bearishly to new lows, we would have done it by now. You could argue. I'm not certain of that. It just feels like that, right? But let's talk about that bearish case then. So the best way I can look at this is that we did have a ABC into a W. We've had a zigzag into an X. And now we're either getting a double zigzag into the Y, or we're just going to get another normal zigzag and it's going to go a lot deeper. So you could argue that we're going to get 1 2, and this is where it gets tricky, right? Because it should be 1 2 1 2 1 and then so 3 4 3 4 3 4, but we get this clear zigzag structure, utterly super clear zigzag structure. right, which doesn't seem to fit at all. Unless we go 1 A, B, C, and then we end up with another flat pattern, maybe. He doesn't have a good look either way. And then we're coming down into A, 4 hour. We're coming down into A, and minor, B, and C to complete the Y. Still overall bullish, because this is still counted as 1 into 2. How you get actually lower than this 2020 low, I haven't figured out. Okay, so feel free. You'd have to, I think, look at this as a snap correction of 3, which for some strange reason, after thousands and thousands of days of correction from 2011, decided to complete with almost no retracement at all and do it in less than a year. Doesn't strike me as believable, that. On a larger time frame, one would expect a retracement like this if you were going to be bearish, and then to new lows. This does not strike me as sufficient. And then after this tiny little correction, we then get a massive wave 1, a 2, and then 3, 4, and 5 to fit in. I'm not sure there's enough room on the chart. So yeah, I know I sound facetious as fuck. I apologise. But I just can't see how we get below that low with a continuing bearish count from that 2011 high. I just can't see how that's part of the same count. But that's fine. I could be wrong. If you've got an idea that's better, please feel free in sharing it. But for me, whether we're bearish and we go lower, we still stay above the 2020 high of $10 or 10.82. But my preference is for a bullish interpretation that we've had 1, 2, 1, 2, and are soon going to go off to new highs. So that is very much how I see gold and silver at the moment. If there's anything I missed, I apologise. Like I said, I'm just getting back into the routine of doing these videos, and they'll get better over the next few weeks or so. So anyway, thank you very much for joining me on this technical analysis of gold and silver. If you're new to the channel and you like what you've seen, please subscribe, hit the like, smash the like I should say. Feel free to leave us a comment in the comment section below. And if you're interested in learning how to do this kind of technical analysis and Elliott wave, there's a whole bunch of educational videos available on the Patreon. If you join at tier 2 or tier 3, you'll get access to them, including the public Discord. And if you actually join tier 3, you'll also get access to the monthly dividend calendar and stock rating system, which I put out as well. So there's a link in the description box below. Feel free to sign up. Take care of yourselves, guys. All the best. I'll be back with you as soon as I can. Bye bye.